All right. Good morning, good afternoon, traders. Today is Wednesday. It's June 4th, 2025. This is You've Got Options for Income Navigator. And today we're going to talk about the original bear trap trade. I am sharing my screen. This is Option Explorer for those of you that are familiar with the software. This is the risk graph, and this is a trade. Trade ID is 3154 that we currently have on. Let's talk about this trade at first. We'll talk about how this trade is set up, what I typically look for, and then we'll look for a trade setup, similar trade, maybe within about, I don't know, 45 days or something close to it. So this trade has been on for 19 days. As you can see, days in the trade, 19. In the last 19 days, the underlying asset, which is SPX, the underlying has moved about a zero point 0.3 standard deviation. So we're not moving with any kind of speed. Yes, we are drifting higher. Initially, we had pulled back, and maybe we'll look at what this trade looked like when the underlying after 1, 2, 3, 4, about 5 days, we had a dip outside of the expected range, and now we're back in. So nothing much is happening. However, if you look at the P&L, we are up about 4.5%, and this is return on risk. Risk being margin that is tied up in this trade. This is a defined risk trade, so we know exactly what the margin is, and therefore we can calculate what the return on margin currently is. We also know what the max potential profit is to the upside if we end up somewhere to the downside, but not quite below our downside break even. So we'll talk about all that as well. Let me first highlight the trade setup for this specific trade, and a lot of my trades are set up very similarly. This trade started. Let's see if I can go back and go back to the beginning of this trade, because I do want to look at what this trade looked like 5 days after we initially took this trade. Give it a second. Hopefully, Option Explorer is going to work with me and we're not going to break anything. So this was the beginning, right? This was day one when we put this trade on. The setup here was pretty easy. I was long the 57.80 put, which was out of the money at around 30 delta. And then I sold a 57.70, so 10 points lower. I sold a put to make this a put debit spread. I bought a 57.80, sold a 57.70. This is a 10-point wide put debit spread. And then I went further out of the money and I sold to open 55.90, which is at around 15 delta. And then I bought a further out of the money put at 55.50 to define my risk. So this was a 40-point wing, right? So this is a 40-point wide put credit spread and a 10-point wide put debit spread. Okay. Now we can talk about how do we figure out what the risk or what the margin requirement is for this trade. I'm going to grab my pen real quick and see if I can explain this to you guys without confusing anyone. So we know that this spread here is 40 points wide. This spread here is 10 points wide, right? This 10-point wide spread is a debit spread. This 40-point wide spread is a credit spread. So to find out what our maximum absolute risk in this trade is, we take the difference between these two spreads. So we have 40 minus 10, right? That's 30 points. 30 points in SPX, the multiplier is 100, equals to about $3,000. Hopefully that's clear. So our max risk on the downside is $3,000. Now we're also collecting a credit for this trade, right? Because the 40-point wide put credit spread has enough premium to cover the cost of this 10-point wide put debit spread, and it leaves us with a $200 net credit, right? So we take 3,000 minus $200, right? Our margin requirement for this trade is $2,800. Okay. And you can see it here, right? Oops. Our margin is $2,800. So how do we, or where does this trade make money and where does this trade lose money? Let's go through this again. So we know that we're collecting a net credit of $200. That's the most we can make anywhere above the long put at 57.80. So anything 57.80 or better at expiration, we make $200. So this, and we call this the tail profit. Okay, so this is our tail. So our tail profit, if we take 200 over 2,800, right? Let's do math real quick here. So 200 divided by 2,800, it's about 7.15% return on margin, right? Our margin is $2,800. Our tail profit is $200. That is 7.15% return on margin. If we are going to catch the price of the underlying asset at expiration, again, this is all at expiration. If it is somewhere below our short leg of the put debit spread, which is 57.70, and above our short leg of the put credit spread, which is at 55.90, so we have, right, these two strikes, somewhere in between these two strikes. What's the profit there? The way we figure that out, we take the width of this spread, which is 10 points, right? 10 points in SPX equals to $1,000 plus the tail profit, which is $200. And that gives us the trap profit of $1,200. So here, our max potential profit is $1,200. This is our downside break even. And then anything below 55.78 or so at expiration, this is where we start to lose money. Okay, so that's the this is the basics of how this trade is set up, and how do we figure out what our margin is? Right, that's 2,800. Our max potential in the trap, and our max potential reward in the tail. Now we can set this trade up any way we think makes most sense. Let's look at the Greeks real quick. So at the start, right, we started off very slightly bullish, right? We had a positive delta of, let's call this a 1, right? So this was equivalent to being long one share of SPX. Obviously, SPX doesn't have shares, but the delta of 0.92, let's just round this off to 1. Delta of 1 for SPX means that we should expect the value of this trade to increase, right? About $1 for every 1 point move that SPX makes. Right? So we had positive delta to start with very little, gamma was insignificant here. And we had positive theta, right? Which means that for every passing day, right, if the market does nothing on day 1, market does nothing on day 2, right, we would expect to make about $4.50 for every passing day. So maybe in 2-3 days, we'll make somewhere between $12 and $15 just from the decay of all options that are part of this trade. So as you can see, let's actually have a look at what this trade looked like 5 days in, and 5 days later, this trade was put on the 16th. So 5 days. This is with the weekend 1, 2, 3, 4, 5. I believe this is on Wednesday of the following week after we put this trade on. Okay, so we had 5 days have gone by. This was towards the end of the day. Let's have a look at what this looked like during the day. All right, so this is about 3 o'clock standard, Eastern Standard Time. So 5 days later, we had the underlying right move down about a one standard deviation. We were down pretty good. We were down about a 1.5% that day. Sure, this trade is at a drawdown, right? If we're going to place our stop for this trade somewhere, at around downside break even, right? We're not even close to getting stopped out of this trade, so we're just going to have to let it work, right? But if things are going to continue to get worse and, on the downside, you can see we're starting to now increase our directional exposure, right? Our directional exposure is now 1.4. Remember, we started with just shy of 1 on the delta. Now we're at 1.4. So as we calm down, right, you can see the delta is going to start to increase, right? And this is a function of negative gamma, which means that if the market is moving against us, the wronger we are, the wronger we're going to get, if that makes sense, right? If we're wrong on the direction, right, we started off bullish, and if we're wrong on the direction, the further it goes, the wronger we're going to get, I guess, if that makes sense. But then, we also have um, something that is going to help us because delta is not going to be constant, right? This delta is going to change over time, over price, and over volatility. So as the time goes, we should expect, if we get the initial push lower, and it's not going to feel good, right? We're down a couple of $100 here. As the time goes, you can see, let's see what this looks like if we just go and forward, or let's see at the potential T plus 0 line at some point in the future, right? So the red line is the T plus 0 at T plus 12. So from this point on, if we project our T plus 0 12 days into the future, you can see that this trade doesn't become a massive winner right away, but it's definitely going to improve, right? So if we are still here right where we are right now, right? This is on May 21st. If SPX is still at 58.49, right? Instead of being down $115, we can see that we would be still down maybe, I don't know, 20, $30. And, we can do that. So we're looking at T plus 12. So from here, we can go T plus 12 and see what that looks like. Yeah, we would be down at 58.48, or let's call this 58.50. 12 days into the future, we go from being down $111 to only being down $22. So you can see that P&L will improve over time, right? Because our delta is going to decay. The delta is going to change over time. You can see that T plus 0 on this day, the delta is 1.39. 12 days into the future at the same price, delta is 1.35. So not a significant change, but change nonetheless. And then you can see that, if we go forward another 10 days, the delta is going to go from 1.34 to under 1. And now, if we're still in the same spot, right, 58.50, but not 12, but 22 days into the future, you can see that our P&L actually goes from being down 20 something dollars to being plus 120. Right? So just because we get an initial push lower doesn't make this a terrible trade. As long as the market's not really rolling over and we're, crashing, we can go lower, and then given some time will pass, this trade is going to improve, and potentially, right, as the options will decay, we could, you know, look at this trade with, just a couple of days until expiration. You can see that if we are lower and enough time has gone by, this is 34 days into the future. If we do push somewhere towards 57.50 with only a couple of days left until expiration, now we have a really good chance at possibly catching this trade with the trap profit, which, if we just do some very basic math, we can take, we know the trap profit is 1,200. We just talked about this, 1,200 over $2,800 margin, right? This trade has a potential max reward on risk about 40% or so, right? So just because we're pushing lower, yes, initially, if we push lower in the first couple of days, it probably isn't going to feel great. But as the time goes, as long as the market's not completely falling off a cliff, this trade is going to improve and give us a good chance at potentially catching a significantly higher return on risk. It's kind of tricky, like you can play this game, but as we move into the trap, and it looks great with 3 days until expiration, but what would it look like, if we had 23 days until expiration? Well, if we're in the trap with 23 days, it isn't going to feel great, right? So now we moved too fast. We kind of moved in the right direction. We want to move towards the trap, but if it happens very early on, it's not going to feel great. But then again, let's project a couple of T plus zeros out into the future. If we are in the trap, this is, what do we look at? T plus 14. It's not going to feel great. But if we look at T plus 30, right, another 2 weeks goes by, we go from being down, this is about $288 to being up almost $200, right? So there will be a big swing. The key is, again, the market needs to stop going down, and we just need to kind of hang around these levels and let the time pass, right? And if once we're in the trap, you will see that your put debit spread is in the money, which means time passage is actually working in our favor. Put credit spread is still out of the money, so this one is decaying, right? The put credit spread is going to decay with every passing day, and the value of the put debit spread is actually going to increase with every passing day. So getting in the trap is not a terrible idea. The key difference is when. If it happens very early on, it's not going to feel good, but you will have a chance to potentially, make an outsized return. If this happens very late in the trade, that's even better. Like, for example, I'm going to show you where we are right now and what we need to happen in order for this to become a really, really big winning trade. But you can see that with 3 days until expiration, we're still not at full value of the bear trap profit, right? But we are getting a much higher return on risk with 3 days to go. And now, in the next 3 days, what are the risks here? Right? We can take the trade off, okay, and potentially give up the difference between 600 and 1,200. So at 57.50, the value of this trade would still be about $600. So we can give up that remaining $600 potential profit, or we can continue to hold to see if we can catch the price somewhere inside the trap. Right? That's the great part, right? We have a potential of more profit here. The risks are, right? The risks are, if the price runs out, back outside of the trap, we're going to not get the profit here, and we're going to end up with a much smaller profit, right? Because at expiration, we know that this trade is going to yield about a 7% return, or will make $200 at expiration. Whereas if the price stays inside the trap, we can make upwards of $1,200. Or worse, if the market rolls over in the next 3 days, right? If the market really, really rolls over, right, we have a potential of a pretty big loss, which is $2,800. So being in the trap within the last couple of days, right? You have two sides of the coin, right? So on the positive, you have a chance at catching a really nice return on risk. But the risks are if the price moves up, we will give up this $600 that we can potentially capture with 3 days to go. If we end up holding it and the price runs away, we will have given up $400. Or to the downside, if the underlying really rolls, then not only do we give up any unrealized profit, we're also facing a potential outsized loss. Right? So you kind of have to understand, where we are, because a lot of times, retail folks get really comfortable, and especially those that are trading without any kind of visual tool, right? So they kind of know that, all right, so the put debit spread is in the money, that's great. Put credit spread is out of the money, that's great. But then you actually, I mean, it helps me at least, right, to look at the shape of the T plus zero. So now I know that at what point here, right, if we're at 5750, okay, great. If we're at 5700, we're still inside the trap. But unless you could actually see how the T plus zero curve is going to start to change, and then if we go 1 day forward, you can see how much steeper it becomes on the downside, which means the rate of change of your P&L is going to start to increase too, right? So I mean, to some people, they don't mind riding, their P&L curve up and down on this slope, right? On the degree of this slope. Some people just want to take the profit and move on and not, gamble, so to speak, right? Wait to see if we capture the price inside the trap or if the market is really going to roll in the next 2 days. It's a pretty big swing from being up, $600-700. It doesn't take much for the market to move, right? From, let's say from 56.50, right? From 56.50 to 55.70, right? If the market is going to move. I mean, again, during the times when volatility is low, it sounds like, well, there's no way the market's going to move 100 points. It's a lot. But if things are really going to get moving, we know that the market can move 100 points in a heartbeat. So you kind of have to understand, right, how fast is the market moving? Overall volatility is rising? Is the market becoming more nervous? You know is the VIX term structure is starting to go from contango into backwardation? Like there's some other moving parts that you want to look at to make a decision. Do you want to stay here, or is it better to take the profits and get out? Right? There's no right and wrong answer here. You kind of have to understand how we got here, how fast we got here, how much time is left, what's at risk, and based on all these factors, you should be able to make a decision whether or not you want to stay, or does it make sense to take the money and run. In any case, this is what this trade looked like 5 days in, and again, this is at the, I guess, at the lowest point from entry. We can go forward 1 day just to see what this trade looked like the following day at around 3 o'clock Eastern. Right, so we were down about $115. The following day, market goes up 30 points. We're up about 0.5%, and the loss, right, gets cut in about half. Then we go forward one more day. This is Friday, May 23rd. The market is down 17 points. I'm guessing volatility might have gone up a little bit, and we are down. So this is the day where we kind of started to push into the trap with 7 days in. You can see that the P&L here, we're down again about $160. There are still, relatively speaking, right, there are 35 days. If we started this trade with 42 days and there's 35 days left, 35 out of 42, there's still over 80% of the time remaining until expiration. So there's a lot of time left, and we're already starting to kind of, kick in the door of this trap. It's a little too early, but it's nowhere near where we need to be concerned and potentially look to stop out. The way I look at this trade is if we're in the trap, if we're pushing deep in the trap, and there's a lot of time on the clock, clearly the market is trying to tell me something. And the market is telling me that, hey, you took a trade that started off with no upside risk, right? This was a bullish trade, even though the delta might have been only, one or maybe even less than one. It was still a bullish trade, which means that if the market pushes lower, I'm wrong. Market's never wrong. So I can choose to sit here and try to, you know, hold on and wait to prove something to the market, or I need to recognize where, look, I put on a bullish trade with a positive delta, market's pushing lower, my delta is increasing, and at this point I need to decide, what's happening in the markets. Are we rolling over? Here, in hindsight, obviously it's a lot easier, but we lost 8 EMA. We're pulling down to 21 EMA. So, you can say that, all right, if we lose 21, I got to get out of here, right? Maybe the market's going for a 50-day retest. Maybe this is just a lower high, right? And then we're going to continue lower. We don't know that, right? But you need to understand, you kind of have to draw some lines in the sand where, this is my chance to get out before things get a lot worse. Or you can use like a hard stop saying, if we breached the short leg of the put debit spread, clearly the losses are probably going to be a little bit larger, but you're going to give yourself a little bit more room or a little bit more time to be right. But if the price is going to touch the short strike of the put credit spread, maybe that's your signal to get out, right? And you could probably plan, your you can plan the size of your trade based on your stop loss, right? So, based on what we're looking at right now, right? If we get to the short strike, this trade is down about $600, 670, 650, maybe a little bit more if volatility is going to go up, and but volatility here is not a major problem. So maybe we're risking about 3x tail, right? And we get out of this trade whenever it's down $600. And then based on this $600 loss per one contract, you can decide how many total number of contracts you can do, right? If you know that your total allowable loss per trade is X amount of dollars, you divide that X amount of dollars by $600, because we know that when this trade is showing a loss of $600 per one lot, it's time to get out. So maybe let's say your max allowable loss, total loss for any one given trade is $1,800. And that $1,800 represents some percent of your overall net lick. Okay, hopefully we're on the same page. So your max potential or your max allowable loss per trade is $1,800. If you know that if this trade is showing a loss of $600, it's time to get out, right? You divide 1,800 by 600, that gives you max size for this trade of 3 contracts, right? So if you get out at a loss of 600 per one lot, you do 3 lots, that's $1,800, and that is $1,800 is within your max allowable loss per one trade. Right, so you can do something like that, or you don't have to wait until you hit that max loss. You can look for clues in the charts. How, for example, we had, let's say, if we entered something back in February, right, and the market was kind of going and going and going, and then we lost, the 8-day, we lost the 21-day, and now the market, we're losing some recent, very clear levels of, I don't want to call this support, but there was a balance here for a little bit, and then market started to roll, and it did not look great right here. So you decided to avoid waiting to see what the market's going to do next. So there's nothing wrong with getting out of this trade earlier, right? If you rely on your technical analysis, or if you just want to say, look, I'm going to put a stop on the breach of the short strike. The risk in that is that, let's say we close the day at 56.12, and your short strike of the put credit spread is at 55.90, right? You got only 20 points worth of move right before you trigger your stop. You can look at what is the 1 day expected move, right? We kind of know how to figure that out. We can take the VIX reading divided by 16, right? It'll tell you what percentage is expected for the markets to move the following day. And then you can convert the percent into points by looking at the price of SPX multiplied by whatever the percent is. And if the expected move is greater than 20 points in the following day, right? It probably makes sense to just get out of the trade early and not, test your luck. Because what happens is sometimes, right? Let's say we're closing at 56.12. We have 20 points until our stop is going to get triggered. The following day, we get a bounce, and you say, "Whew, thank God I didn't, stop out." So now you're just training yourself to, kind of take the gamble, and maybe the next time we're at 56.12, and you say, "Well, again, we're 20 points away. I'm not going to stop." And then the following day, instead of market going higher, we could gap down 3 standard deviations, and then you're way past your stop. So if you want to be a little bit more cautious, absolutely nothing wrong with saying, let me try to figure out if the expected move for the following day is going to exceed my stop. I might as well get out today. Clearly, this trade isn't going in my direction or in my favor. So it's time to maybe get out of its way. So this is what this trade looked like 1 week after we put this trade on. And now we can go and, maybe a little bit faster and look at what this trade looked like a couple of days into the future. Right, as you can see, the market has bounced and the trade went from being negative to slightly positive P&L. And now this is where we are right now with 23 days to go. So we started this trade at 42 days. We have 23 days left. So 23 out of 42. So we still have about 50% of the time that's left on the clock, right? We know that the max tail profit is $200. We're at 140. So we're almost, we're more than halfway to our max potential profit. So at this point, we're starting to make that decision if we're going to remain in this trade for maybe another 20 days to see if we could potentially push and end up somewhere in the trap. This is I don't want to call this a gamble, but it is a risk that if we are going to push, from today's prices, in order to get to the trap, we need to move, almost 4% to the downside. I think that today, right, based on everything that's going on, if we do get a 4% pullback, is this going to be just, your regular 4-5% correction? I think if the market is going to move 4% to the downside, it's probably going to happen with a little bit more speed. Market's going to get a little bit more nervous because, we're just kind of in this time of uncertainty between all the, tariffs and all these different geopolitical things that are going on. So I think, playing for the trap profit here is a bit more of a risk than anything else. There's absolutely nothing wrong with saying, look, I'm putting $2,800 on the line for this trade, right? This is what you had to put up with your broker to put this trade on. The $2,800 that you put at risk has earned about, almost a 5%, 4.5% return in 19 days. Right? Maybe it's a good idea to get out. That's option number one. Maybe you say, I'm going to give this thing another week. As you can see, in another week, if we're still where we are right now, we're probably going to be very close to maxing out tail profit. Maybe you take that off and get out then. If we move lower, but without any significant spike in implied volatility, I think P&L is still going to improve, right? We're not going to be at full tail profit potential, but very close to it. The key here is if we are going to stick around and play for the trap profit, we need to see move lower, but very, very quiet move lower, right? We don't want to see, down 2% days because if we move down 2%, right, odds are, what's the VIX trading at today? VIX is at VIX is at 17 and a half. If we move 2% to the downside in any one day, VIX is not going to go to 35, but we're probably going to move, you know, somewhere around 21, right? And if volatility is going to spike to 21, we can bump volatility up 4 points. You can see that, T plus 0 is going to get pushed lower, right? So things aren't going to be as great as, what this software is projecting. But if we are going to play for the trap profit, any move to the downside needs to happen with not a lot of speed. So if we are drifting lower and it's, kind of within, right? So VIX at 17 and a half, what is one day expected move right now? So we take 17.5 divided by 16. So the market is pricing in, about a 1.1, you could round this off to about a 1% move up or down in any given day, right? So if we're moving within expected, so if we're moving, maybe 1% up or down, if we're moving 1.2% up or down, that's still more or less within expected. But if we start to move, 2% today, 2% tomorrow, VIX is going to go into mid 20s. And, this trade could potentially introduce even more risk of, ending up way past our downside break even and things, nothing fun is going to happen down there. So I'm just going to sit tight with this for right now. We'll see what happens towards the end of the week. Again, are there some things we can do to possibly remove some of the risk? Yes, we can maybe roll. We can maybe roll the 57.70 up to 57.75. So we're going to shrink, right? We're going to cut the width of the put debit spread in half. So we're giving up the trap profit. We're bringing in not a significant amount of credit, about 65 cents. Can we spend the 65 cents to do something with downside risk, right? Because we don't want to increase downside risk. Yes, we are, by cutting the width of this put debit spread in half, right? We're cutting our potential profit in the trap, which is not good. We're going to potentially increase our downside risk or the margin requirement from 2,800 to 3,200. Not good. But the good is that we're going to increase our tail profit by 65 cents or $65 per one contract. So we kind of want to think to ourselves, is it worth increasing our downside risk about $500, removing our trap profit potential by about $500 in order to increase our tail profit by 65 bucks? Right, the odds still don't change. This is still a very high probability risk graph. You can see that our downside break even at 55.80, right? You can look at 55.80 has a delta of 8, and if we use delta reading as a proxy for probability of profit, right? There's about a 90+% probability that the price of SPX is going to be somewhere above 55.80 at expiration. So it's still pretty high probability that this trade is going to make money. So I'm not a big fan of this particular adjustment, rolling the one of the legs of this put debit spread. It just doesn't bring in significant enough credit for me to, maybe I wanted to spend that credit and instead cut my downside risk, right? Maybe to something like this, but then what's happening here, right? If I cut my put debit spread width in half, right? That brings in a credit, and then I spend this credit to reduce my downside risk, remove my margin requirement from 2,800 to about 1,300, right? So I'm removing about $1,500 worth of downside risk. This is going to be at a cost, right? So I'm not collecting a net credit. I'm actually going to pay about 30 cents, 20 cents. Right. So just something like this. So I could potentially, and maybe this isn't wrong, and you can see, how does this change my Greeks, right? So the delta goes from, zero point 0.5 to zero point 0.3. So I cut my directional risk, right? So if you're kind of cautious here, if you're not sure if the market's going to continue higher, or maybe we're due for, pullback in the test of some key moving averages, it's not a terrible idea. You just have to understand that, you know, you have to look at two sides of this coin. What are you gaining and what are you giving up for it? So the gain here is you get to reduce your margin by $1,500, right? $1,500 from $2,800 where it is right now, right? We take 1,500 divided by 2,800, right? We cut the margin requirement by 50%, which is great, right? But what are we giving up? We're giving up half of our potential profit in the trap, and we're reducing our tail profit from 200 to $175. Not saying it's right or wrong. I'm just saying you have to think, is it worth to give up, $25 in the tail and potentially, $500 in the trap in order to cut my margin by 50%? If the answer is yes, then this is a good idea, right? If the answer is no, then sometimes the hardest easy decision is to do nothing. Just sit on it, right? Sit on it, see what happens, see where we are. Like a trade like this, you can, just look at it once a day. As long as the market, again, if the expected move for the day is about plus minus 1%, if you look at the S&P 500, if we're not down more than 1%, you probably don't even need to look at this trade, right? As long as you know where you are in this trade, as far as, or in relation to where your, trap, where your trap is. If you're still way away from it and the market's down less than 1%, or if it's up, you probably don't even need to look at this trade. If the market is moving 2% and, you're starting to get concerned, yeah, you can look at it and see if and what needs to be done. But most of the time, it's nothing. Unless you're very close or inside the trap, then you need to be a little bit more proactive with this trade. So let's take a look at something that we can maybe set up for a new position entry. Let's go and see what we got at about 45 days. Let's see. Last trade we did was 42 days. We have something at 44 days. So 44 days is a July monthly expiration, right? We have the Thursday and we have the Friday. Friday is the weekly, right? The monthly expiration, these contracts will stop trading on a Thursday and they will be settled based on the opening print on the Friday morning. You can choose either one, doesn't make a difference. They're very close in price. If you want to just keep it simple, I like the weeklies. You may say that, you can find more liquidity or better fills. I don't think it's significant enough unless you're trading, enough size to, make a half a penny really make a big difference. Yeah, let's look at the weeklies, but it really doesn't matter. So the setup was, remember the last trade setup was a 10-point wide. So we can use that as a kind of a starting point. And then based on what this trade would look like on our screen, we could make a decision, maybe we want to move strikes a little bit. Maybe we want to make a debit spread instead of 10 points, 15 points, or maybe we need to make it, 5 points. And whatever the case may be, my goal for this trade, to keep it simple, right? Let's look at a setup where we are going to sell a 50 point wide put credit spread, and we're going to buy a 10 point wide put debit spread. What that means is that our max risk in this trade, right? We have a 50 point wide put credit spread and a 10 point wide put debit spread. The difference between these two spreads is 40 points. 40 points in SPX is $4,000. And if we collect the credit for that trade, right, that credit is going to go towards reducing that buying power requirement or margin requirement from 4,000 down to whatever it's going to be. So let's just jump in and see what we can do. You know, a good starting point. Sometimes I like to look at what is being priced in for July expiration. This is July 18th. I don't care about this strike that I put down on it, but what I'm looking for on my screen, this darker gray area, is the expected move based on current implied volatility, which is relatively low. Right now, IVR is pretty low on SPX. Market is not really implying a whole lot of movement. So the expected range right now is somewhere between 56, 68, all the way up to about 62, 90 or something like that. Right, so maybe we'll go outside of the expected range, right? We want to give ourselves a little bit more room to the downside, and we'll sell. Let's start with 55.35 for, let's make this 55.30 to keep the numbers round. And then from 55.30, we're going to go down 50 points. Right, so we're at 54.80. Okay. We are looking at a very high probability put credit spread. This is 50 points wide, right? So this is a $5,000 risk minus credit. Credit here is about $400. So margin here is $4,600. And now we're looking to buy a 10 point wide, put debit spread. And maybe we want to make $200 in the tail, which means that we could only spend $200 on the 10 point wide put debit spread. Let's see if we can find a 10 point wide put debit spread somewhere around, I don't know, Delta 35. So if we buy 158.60 and then sell 158.50, that's pretty close, right? So what happens here? We pick up a 10 point wide put debit spread, right? This will knock our credit from 400 to about 170, right? So this 10 wide is actually costing $230. The breakdown here is the difference between these two spreads, which we know is 40 points or $4,000 minus 170, right? Let's assume that this is going to be our trade setup. So the tail profit here is 170. Inside the trap, we'll make the width of this spread, which is 10 points or $1,000 plus 170. So about 1170 in the trap. And our risk is the difference between these two spreads, which is 40 points or $4,000 minus the tail profit, which is 170, right? So we end up with 38.70 of margin requirement. Now you can do the math and say, okay, what am I going to make? What kind of return on margin am I going to make if the price stays somewhere above, right, the long leg of the put debit spread, which is at 58.60 around Delta 35. We'll take 170 over, it's 38.30, sorry, over 38.30, right? So 170 divided by 38.30, yeah, you get about 4.43%. Okay, that's not terrible, right? You get a 4.43%, and maybe you could get out of this trade in 30 days. Not a terrible setup. Again, this is a bullish trade. Why? Because if the market goes down, this is our risk. We don't know if the market's going down, but that's where our risk is. We need the price to go up, or go up a little or down a little. It could go even down as much as between 3 and 4%, just not early on. We just don't want the underlying to move, in excess of 7% to the downside. So anything above, 5,600, we're good. When we get to 5,600, what's our potential loss at around 5,600? I think it's going to be somewhere around $600. $600 loss on about a $170 tail. All right, so it's close to 3x potential tail. So maybe we set the rules for this trade. All right, if we're out or if we're down $600, we're going to cut this trade. So every day, if you want to look at this every day, once a day, or if you want to look at it 3 times a day, it doesn't matter. If at any time you look at this trade and it's down $600 per one contract, it's time to get out, right? You can make that non-negotiable for yourself. Don't look around. Don't look for ways to adjust. There's not a ton we can do because, we're taking in $170 credit. We don't have a lot of credit to spend to, dance with this trade and make some fancy adjustments. It's pretty simple. It's a pretty high probability setup, right? This should work about, I would say, about 80 to 85% of the time. You're going to get the tail profit. Why? Because if we look at the long leg of the put debit spread, it has a delta of 35. Right? What it means is that about 65% of the time, right, we're going to be somewhere above this strike at expiration. So 65% of the time, you're going to get the tail. And then there's going to be some times that you're going to catch the tail. Um, you're going to catch the trap profit, right? So just because we go below this 58.60 strike, that doesn't mean the trade is busted, right? There's going to be times where, within a few days of expiration, we may be inside of the trap, which is great, right? So, but 65% of the time, we're going to just get the tail. There's going to be some times when we get the trap profit, maybe not full, partial, half of it. I don't know, right? And then there are going to be some times where we get a bad move against us and we're going to have to stop out. And we can look, if our stop right now is at 5,600, right? What is a 5,600? What is a 5,600 put delta? A 5,600 put delta is about 16. So we would assume that 5,600 put has a probability, right? It has a probability of profit about 85%, but it also has probability of touch, right? There is about a 30, maybe 30% chance that will touch 5,600. So 70% of the time, you're not going to get stopped out. 30% of the time, you might hit a stop. And that's based on current implied volatilities, right? So don't take that as a writing, in black and white. Things could change if implied volatility is going to change, but that's the setup, right? It's a very high probability setup. There's a very good chance we might end up somewhere in the tail or spend most of the time in this trade somewhere in the tail, which is what's happening right now in the trade that we have open. There are going to be some times where we're going to kind of, dance around very close to this bear trap, and maybe we actually pull into the trap later on in the trade. Those are really, really not rare, but it doesn't happen very often. But when it does, we have a shot at making a significant return. And then there are going to be some times where we put this trade on and the market just looks, whatever. And then, we get a couple of days, especially now, markets are driven by headlines. We get a couple of bad headlines and the market's pulling in and pulling in and pulling in, and we have to stop out. Right. So this is the kind of a trade setup I'm looking at for SPX. Can this be done in SPY? Yes. Can this be done in ES? Yes. Right. Now, if you consider doing this with ES is, they use a span margin. So, your margin may be much lower than what your equity or index options are going to show. So don't, I mean, I don't want to say don't use the leverage, just be responsible. Just because, the broker may require, much lower initial buying power requirement if you're going to do this in ES doesn't mean that you need to load the boat and, swing for the fences here. Be responsible, understand your risks, and, let the probabilities kind of play out. I think this is a really good setup. As long as the market is more or less stable, like if what I want to put this trade on, if the market, if the VIX is at 35 and the market is going up and down 3% on a day-to-day basis, absolutely not, right? You may say, well, why, right? You have, high volatility is great. This is a, a short Vega trade. You have positive theta, all this stuff. Sure, that's all great. But don't forget that this trade wants slow movement, slow up, slow down, up, down, maybe down, but very slowly. And then eventually we need to work our way in to this trap. But if the market is moving up 3%, which is okay, fine, down 3%, now you're just getting closer and closer to your stop loss very early on. This is not going to feel well. I think that, most of the time the market is not crashing, and most of the time this is a great trade. You just have to understand, what's happening in the market right now. If the market is more or less stable, I think this is a great setup. If the market starts to get nervous, if we see some kind of backwardation in volatility term structure, this is not the kind of trade I want to do. If you need to stop out and wait for things to settle back in, then I think that this is the right thing to do. Right. So we are going to try to put this trade on, tomorrow. I'm going to look again, right? Market's just closed. We're closing on the lows of the day, which is not a terrible thing. We're actually, it's maybe a good thing, right? Market closing down on the day. You probably want to enter this trade when the market's pushing lower. You get more premiums, right? Which means you can place your structure a little bit further out of the money. It's not a terrible thing. Right. But the point is that whether I put this trade on today or tomorrow, it doesn't make a difference. Right. I can find this setup. All I have to do is move these strikes up or down, move my credit spread up or down, whatever the case may be, as long as I know where I'm trying to go and I'm just trying to figure out a way to get there. So my goal here is to maybe, right, keep my margin requirement, right, under 4,000. Why 4,000? I don't know. 4,000, maybe to somebody it's not 4, maybe it's 7,000. Whatever. Again, we're all trading different account sizes, right? So it's whatever you want to have at risk at any one given time. What if I wanted to do this trade and keep my margin requirement under 2,000? Can I do that? Right? 2,000. Sure. Maybe instead of doing a 50-point wide here and a 10-point wide here, maybe I'll do a 30-point wide put credit spread, right? And a 10-point wide, put debit spread, right? The difference between these two is $2,000 minus credit. So I can find the trade that's going to take up less than $2,000, and that's a great trade for smaller accounts. If you have a larger account and you don't want to do, 600 contracts, then maybe you just need to, you know, go a little bit wider on the spreads, and you get to control how much margin is required for this trade. All right, but I think that the simplest way to do it is to maybe keep the trade um, somewhere around $4,000 minus credit. Last trade I did, I instead of doing a 50 wide, I did a 40 wide and a 10 wide. So this was a 30-point requirement minus credit. So the total margin was under $3,000. So I'm going to try to do this trade tomorrow, right? We're going to look for a 50-point wide credit spread, a 10-point wide debit spread. Hopefully, we'll get to collect somewhere around $200. If you want it a little bit more than $200, guess what? You have to either move your put debit spread closer and move your credit spread closer, or move them both farther out of the money. But you move them to where you find your desired credit with your desired, whatever your desired margin requirement is, and that's where you find your perfect trade entry. Hopefully this makes sense. If you guys have any questions, you can ask questions on Discord. We're going to wrap it up here. Thanks everybody for your time. Hopefully I got you to think about these trades a little bit. And again, if you have questions, you find me on Discord. I got to run. I'm going to talk to you guys later. Have a good day, everybody. Bye-bye.